In 2024, the average American with a 401k had about $134,000 saved for retirement. Sounds decent until you realize something. Financial planners estimate most people will need $2 million to retire comfortably. That means millions of Americans are heading toward retirement, hundreds of thousands of dollars short. But here's the strange part. Many of them had access to one of the most powerful wealth-building tools ever created. A tool that can double your money before you even invest a dollar. And yet, a shocking number of people either ignore it, misunderstand it, or use it the wrong way. So the real question is the 401k actually the best retirement account, or is it quietly one of the most misunderstood financial tools in America? Because once you understand one hidden rule about 401ks, it can completely change how you build wealth for retirement. And almost nobody talks about it. Let's start with a simple reality. Most Americans are not confident about retirement. According to a 2023 Gallup survey, only 43% of U.S. adults say they believe they'll have enough money to retire comfortably. That means more than half the country is unsure about their financial future. And one major reason is confusion around retirement accounts. People hear terms like 401k, Roth IRA, traditional IRA, index funds, ETFs, and it starts to feel like a completely different language. So instead of learning it, many people just delay investing altogether. But that delay is extremely expensive. Because retirement investing is driven by one force that rewards time more than anything else: compound growth. And the earlier you start, the more powerful it becomes. But here where things get interesting. The 401k wasn't originally designed to become America's primary retirement plan. It actually started as a tax loophole in the late 1970s. And today, it has become the backbone of retirement for over 70 million Americans. But using it the right way requires understanding something most beginners never learn. Why most investors get it wrong. When people first hear about a 401k, they usually hear something like this: put money in your 401k so you can retire. That's technically true, but it misses the real power of the account. Because a 401k is not an investment. It's a tax shelter. Think of it like a container. Inside that container, you can invest in things like index funds, mutual funds, ETFs, bonds. But many beginners make a critical mistake. They contribute money but never choose good investments inside the account. Some people leave their money in low-growth funds or cash equivalents for years, which means their retirement savings grow far slower than they should. And that brings us to the first important concept. A 401k is an employer-sponsored retirement account. It allows workers to invest part of their salary before taxes are taken out. This reduces your taxable income today. For example, imagine you earn $70,000 per year. If you contribute $6,000 to a traditional 401k, your taxable income drops to $64,000. That means you pay less tax today. Then your investments grow tax-deferred. You only pay taxes when you withdraw the money in retirement. But that's only part of the story. Because the real advantage often comes from something called employer matching. And this is where things get extremely powerful. Many companies offer a 401k match. This means your employer contributes money just because you invest. A common structure looks like this: 100% match on the first 4% of salary. Let's translate that. If you earn $60,000 per year and contribute 4%, you invest $2,400. Your employer also adds $2,400. Instantly, you now have $4,800 invested. That's a 100% return on day one. No stock market in the world can guarantee that. But here's the shocking statistic. According to Vanguard retirement plan data, about 25% of employees do not contribute enough to get the full employer match. That means millions of people are literally leaving free money on the table. and over a 30-40 year career. That mistake can cost hundreds of thousands of dollars. But here where things get even more interesting. Because the real magic of a 401k isn't just the match. It's time plus compound growth. Let's look at a simple example. Imagine two people. Alex starts investing $400 per month at age 25 into a 401k. Jamie waits until age 35 to start investing the same amount. Assume an average return of 8% per year, which is roughly consistent with long-term stock market returns. By age 65, Alex ends up with about $1.4 million. Jamie ends up with about $611,000. Same monthly investment. Same returns. The only difference: 10 years. Those 10 early years produced nearly $800,000 more wealth. That's the brutal math of compounding. And this is why retirement experts constantly repeat the same advice. Start as early as possible. Even small contributions matter. But here's the twist most people don't realize. Your 401k investment choices matter just as much as how much you contribute. And choosing the wrong funds can quietly destroy thousands of dollars in future wealth. We'll break that down in a moment. But first, I'm curious about something. If you're watching this right now, how old are you? Drop your age in the comments. It's always fascinating to see when people begin learning about investing. And if you already invest through a 401k or brokerage account, which ETF or index fund do you currently own? I read the comments and they often turn into really helpful discussions for new investors. Now let's talk about the biggest mistakes people make with their 401k. Because some of these mistakes are surprisingly common, even among high earners. And fixing just one of them can dramatically increase your retirement savings. Common 401k mistakes that quietly cost you thousands. Let's start with one uncomfortable truth. Many people are doing the right thing by contributing to their 401k. But they are investing the money poorly. And that difference can easily cost hundreds of thousands of dollars over a lifetime. Here are some of the most common mistakes. We mentioned this earlier, but it's worth repeating. If your company offers a 401k match, that should usually be your first investing priority. Why? Because the match is essentially risk-free return. Imagine someone earning $80,000 per year. Their employer offers a 50% match on the first 6%. If the employee contributes $4,800 per year, the employer adds $2,400. That's $2,400 in free money every single year. Over a 30-year career, assuming a modest 7% return, that employer match alone could grow to over $240,000. Yet millions of employees still contribute less than the match threshold, which is financially similar to rejecting part of your salary. And this leads to the second mistake. Some investors open their 401k, contribute money, and then park it in very low-growth funds. For example, money market funds, stable value funds, short-term bond funds. These might return 2-4% annually. But historically, the U.S. stock market has averaged about 10% annually before inflation, according to long-term data from sources like Ibbotson and S&P Market Research. That difference is enormous over decades. Here's a quick example. If you invest $500 per month for 35 years, at 4% return, you end up with about $540,000. At 8% return, you end up with about $1.15 million. Same savings, same time, but more than double the wealth. This is why many long-term investors prefer low-cost index funds or ETFs inside their retirement accounts. But there's another mistake that quietly eats away at retirement savings. And this one is much harder to notice. Every investment fund charges an expense ratio, which is basically the cost of managing the fund. Some actively managed funds charge 1% or more per year. That might sound small, but over decades, fees compound just like returns do. Let's compare two scenarios. You invest $500 per month for 35 years, earning 8% annually. Scenario A, low-cost index fund with 0.05% fee. Final value approximately $1.13 million. Scenario B, actively managed fund with 1% fee. Final value approximately $930,000. That's about $200,000 lost to fees. And this is exactly why legendary investors like Warren Buffett have repeatedly argued that low-cost index funds beat most actively managed funds over long periods. So choosing simple, low-cost funds inside a 401(k) can dramatically improve your long-term outcome. But now we need to talk about something many beginners struggle with. Traditional 401(k) versus Roth 401(k). Most employers offer two versions of a 401(k). Traditional 401(k), Roth 401(k). The difference is when you pay taxes. Traditional 401(k) contributions reduce your taxable income today. Investments grow tax-deferred. Withdrawals are taxed in retirement. Roth 401(k) contributions are made after tax. Investments grow tax-free. Withdrawals in retirement are tax-free. So which one is better? The honest answer is, it depends on your tax situation. Here's a simple rule many investors use. If you expect your future tax rate to be higher, Roth can make sense. If you expect your future tax rate to be lower, traditional may be better. For example, a 25-year-old earning $50,000 today might be in a lower tax bracket now. Choosing a Roth 401(k) could allow decades of tax-free growth. But someone earning $200,000 today may prefer the traditional tax deduction. There's actually a fascinating debate happening among financial experts about this topic. Some argue Roth accounts will become more valuable if taxes rise in the future. Others believe traditional accounts remain more efficient for high earners today. So here's a question for you. If you currently invest for retirement, do you prefer traditional or Roth accounts? I'm curious to see where people stand on this. Drop your answer in the comments. Because the discussion around this topic is often surprisingly divided. If someone opened a 401(k) today and wanted a simple, rational strategy, it could look like this. Step 1. Contribute at least enough to get the full employer match. Never leave free money on the table. Step 2. Choose low-cost index funds or ETFs inside the account. These often track major market indexes like the S&P 500, total U.S. stock market funds, global stock funds. Step 3. Increase contributions gradually. Many plans allow automatic annual increases. Even raising contributions by 1% per year can dramatically boost retirement savings. Step 4. Stay consistent during market crashes. This step might be the most important, because history shows that markets always experience volatility. We saw major declines during the dot-com crash, the 2008 global financial crisis, the COVID-19 market crash. Yet over long periods, markets have recovered and continued growing. Which brings us to one of the biggest psychological challenges investors face. Many people start investing, but when the market drops 20–30%, fear takes over. They panic, they sell, and they lock in losses. But long-term investors understand something important. Market crashes are not just risks. They are also opportunities to buy assets at lower prices. Historically, some of the best long-term returns came from investing during periods of fear. But staying calm during those moments is extremely difficult. Which is why automation like automatic 401(k) contributions can be so powerful. It removes emotion from the process. Money keeps investing every paycheck. No guessing. No timing the market. Just steady accumulation. And over decades, that consistency becomes incredibly powerful. Let's quickly recap the key ideas. A 401(k) is not an investment. It's a tax-advantaged retirement account. Its power comes from three things: employer matching, tax advantages, long-term compounding. Avoid the common mistakes: missing the employer match, Choosing high-fee funds. Investing too conservatively. Instead, focus on consistent investing. Low-cost funds. And a long-term mindset. Because retirement wealth is rarely built through dramatic moves. It's built through small decisions repeated for decades. One day in the future, your older self will depend on the financial decisions you make today. And the difference between starting now or waiting a few more years can quietly become hundreds of thousands of dollars. If this video helped you finally understand how a 401k works, consider hitting like so more people can learn these fundamentals. And if you're interested in ETF strategies, index fund investing, and long-term wealth building, subscribe to the channel. Because understanding investing isn't about getting rich quickly. It's about making smarter decisions consistently over time. And if you want to go one step further, you might want to watch the next video about how beginners choose their first ETF. Because once your 401k is set up correctly, what you invest in next can make a huge difference. Wealth in the stock market rarely comes from predicting the future. It comes from patiently owning the future for a very long time.